Good afternoon, everybody, and welcome to the LendIt Fintech News Weekly Fintech Roundup. My name is Peter Rented. I'm chairman and co-founder of LendIt Fintech, and I'm joined by my good friend and colleague, Todd Anderson, and a special guest today, Kabir Kumar. How are you doing, guys?
Hey, Peter. How are you?
Great.
Doing great.
Great. Kabir, why don't we just get started? Before we get started, why don't you just introduce yourself real quick, let the audience know who you are and what you do.
Thanks, and it's great to be here, Peter and Todd, and great to chat with you. I'm with Flourish Ventures. We are a venture capital firm that's backed by Piero Mediar, who founded eBay. And we back entrepreneurs with purpose, trying to build a fair financial world. And I'm based out of DC for the firm and look at investments in the US and globally.
Mm-hmm. Okay, well, let's launch right into it. We got a lot of interesting news stories to cover. It's been a short week, but a busy one. First one I want to get to is about Chime. There was a ProPublica report that came out this week. A lot of different people covered it. We saw American banker Penny Crossman wrote a piece about it. Chime have been closing people's accounts without warning, and it's part of their anti-fraud efforts. And they tell a horrible story of a father out to lunch with his two kids, mm-hmm. and he goes to pay with a Chime card, and he gets declined. And he just checked his Chime card that morning, and he had his stimulus money came in. He had over $10,000 in, and he couldn't pay with his Chime card. So, it's a tough problem because we do want to fight fraud, but people, innocent people can get caught in the crossfire. What do you guys think?
I think Chime is falling victim to being the leader in the pack right now, mm-hmm. Because there's others that this happened to. I think the American banker piece references Varo that this happened to as well. So this is happening. I think there needs to be a little bit more clearer of a process of telling people. Or maybe verifying that that there might be some fraudulent things related to the account. I don't know if just closing it is the way to go. Maybe in certain cases you can just close it, like if there's all these weird transactions but I think there needs to be a better, more defined process outlined and there needs to be some back and forth with the customer. I mean, fintech has created and automated a lot of great things. This is one negative side of it, where it's like too much automation.
Yeah, I agree with you, Todd. I think part of the story is just how you communicate with your customers. Chime may not have had an option there. It's sort of its bank partners they've agreed to a process of what happens with fraud, and this is one of the options. That Peter, that story in ProPublica profiles that father. He's one of, I think, 13 cases that are at the center of that investigative report. Mm-hmm. And it turns out half of them were actual cases of fraud. And 5 of them were false positives. This is in the ProPublica piece, because the headlines grab our attention.
Right. Yeah.
And if you read through the piece, 5 of them were were false positives. And so in part, it's also a story of how compliance systems work.
Right.
And so compliance systems do spit out false positives. And I think that we just haven't sufficiently innovated in that space overall. And this is a problem that not only neobanks face or fintechs face, I think it's a problem that the banks face. And if anything, banks and the regulators might have even created this problem by sticking with, dated technology. But I think there's another piece of the story that I find interesting, mm-hmm. which is the stimulus payments. Right. Because all 13 cases are cases of government payments. And I don't know if you caught this NPR piece earlier this year with the Bank of Guam. Did you guys catch that? It was really fascinating because there were Americans living in Micronesia, banking at Bank of Guam, who suddenly got their accounts frozen or saw negative balances because it was determined that they were not supposed to get stimulus checks. And it was, part of this ongoing effort of everything that's gone wrong with the pandemic payments, right. Deceased people getting it, GA report showed that. I feel that's the other part of the story is the sort of ongoing problem we have with the absence of an identity system in this country.
Right, exactly right. We need that would solve a lot of problems if we had a really robust identity system, because that's the thing. I mean, you don't want to give people warning that their account's going to close if they're fraudsters, because they're just going to drain the money out and it's gone. So you've got to kind of close it down without warning. And as the Chime spokesman said in the article, that it's a tiny fraction of a percentage point of 1%, a tiny fraction of 1% of their accounts that have been treated this way. And so it's a tough problem. It's not you're not going to. I mean, I don't think 100% accuracy is going to be possible. And it's easy. Say it makes good headlines, makes good reading, but Chime are probably. Said they might be forced by their bank partner, but they're doing the responsible thing in many ways.
I talked to the CEO of Centrelink, when I had him on my podcast, and he was talking about how a lot of the states that were releasing benefits didn't really have any checks at all, basically.
Right.
So even the most basic structure and compliance in place would have set up such a safer way to do it. A lot of them didn't have anything. And so that, I think, the piece that Kabir you mentioned is kind of the more underlying piece of the story, which is the government payments and how reckless essentially that they were, though needed to get out the door. There were some basic controls they didn't put in place.
And also the government basically delegated to the private sector, right? Instead of saying these are the people and we've already determined them. Like in Singapore and India, payments were dispersed within seconds. And in some markets, you didn't even need to sort of raise your hand. You were preset. It was determined that you will get these payments already from the government data that's there. And so I think there's a way to solve these things. There's some good ideas out there. And so I think that's part of the underlying story here.
Yep. Yeah. Okay. Well, we need to move on. I also want to reference Ron Shevlin's piece. We had Ron on the show last week, and we were talking about Robinhood, and he wrote a piece that published on Tuesday, talking about, the headline is great: the $30 billion cockroach of fintech. Yeah, that's how he's describing
and he was previewing it on our show last week.
Yeah,
he essentially said that when he was talking about how they're the most inauthentic fintech out there, because I thought the funniest part of the piece was the Frank Rotman Twitter exchange, where his friend is like, well, it's free to me, and he's like, well, they're making money on your trades by doing the payment for order flow. And he's like, well, first, I've heard of it. It's free for me.
Right.
It's like, all right, but they are making money off of you.
Exactly. Well, I think there's the other thing here is sort of what is good fintech versus bad fintech. And I think the good fintech part of this story is people do need a way. We need more people to invest in the stock market. And it's been full of friction. It's been a disaster, in fact, in many ways. And if one thing Robinhood has made it, competition has introduced zero fee investing, I think, right? TD American, there are a whole bunch of at least 3-4 players that have now introduced zero cost trading, which is a good way to get more people to invest. I think that's a good thing. Financial Health Network that we work with, it's a very important pillar of financial health overall. That's the good part. The bad part of it is the underlying business model, because we are the input. We are not the customers. As traders, we are generating the data that they are then selling to, I think, market makers. I think they're selling 60% of their revenue comes from 4 market makers. And so I think that's really the problem. And I think regulators should be focused on figuring out a way to kill these business models. So it's a game of whack-a-mole. You can go after the fintech, but really what you need to do is regulate data use. You need to regulate how data is used in these underlying business models.
Yep. Yeah. And the thing is that, Robinhood, as I said, has done a lot of good. I mean, I think people are not going to, we're not going to go back to paying for stock trades. And that's just, that's not going to happen. But, whether or not the payment for order flow is a good thing, if it's not, if that gets legislated out of existence, they're going to, I don't know how we're going to maintain free order flows. But, Schwab is offering it. There's Fidelity offering it. We're not going back, and that wouldn't have happened without Robinhood and their very disruptive business models. So,
For sure.
I think he maintains that they're the least authentic fintech company because they talk about democratizing finance, but everything is so kind of it's so opaque that you really have no idea. And he talks about the hypocrisy of the Gen Z and millennials who really want to deal with authentic companies and transparent companies, and Robinhood is sort of anti all of that, or they're the opposite of all of that. So it's
a funny piece.
Yeah.
There's one thing I would disagree with Ron, which is that I think we are all naive, not just the Gen Zs and the millennials,
it's true,
about these businesses. I mean,
right.
We participate in these tech companies where we, in fact, our participation is the source of revenue for them, and that's part of the data economy. So we do it. We all do it.
And we don't read the terms and conditions.
We don't, exactly.
Yeah, if it's free for us, like the guy said, if it's free for us, that's our main thing. Like, oh, it's free for me. All right, they're using my data. Like, Facebook's listening to me. It's whatever.
Exactly. It's too hard to understand what that means. I can do this stuff, and it's good for me. And so we are all, subject to his criticism.
Yeah.
True.
Yeah. Okay, I want to move across the pond briefly and talk about Wise, formerly Transferwise. They completed their direct listing. I think it was just yesterday. They got, at the end of day one, they were valued at more than $12 billion. It's the largest direct listing ever in London, and we had the CEO at our 2020 event, virtually, obviously, and it was really just a super interesting company, and one that is trying to introduce transparency. It is trying to do the right thing. And I've been a TransferWise customer for, I don't know, like 8 years, 7 years, something like that, and really value how easy they make it to move money between countries. And that's something that I feel like until I tried them, it was a pain. I had to physically go down to a bank branch, and that was just such a painful process. And then you get ripped off. So they've made it easier and they've made it cheaper. And they're now the owners, the founders are now very, very wealthy men.
I don't think they get the credit they deserve for what they've done so far. I do think the move to Wise was a weird one because people still they're synonymous with TransferWise, and I think it was a strange move because if you see what, like, anytime I see it, I kind of pass by and I'm like, oh yeah, it's TransferWise. It's so I still don't associate Wise with them, but I do think that overall they don't get the credit that they deserve for what they've done so far. And I think, what was it, 0.68% was the average fee they charged, which is eons below what a bank would charge.
Mm-hmm.
Yeah, I think the name change probably speaks to the broader ambitions beyond the movement of money.
Sure.
And so, but I would, can you find me someone in the fintech world who is unhappy about this news? I think this is one of those stories where everyone is happy. Like, these are the good guys of business. Yes, the VCs made money, but this is the right way. They solved a real problem. I think that's what you were getting at, Peter.
Yeah.
Everything that we would want to go right, with fintech business models. I know some folks who are early investors, TransferWise, and are tremendously delighted at the way this has turned out and speak very highly of the founders and so on.
Well, they're also not a typical fintech company insofar as they're actually profitable and have been profitable for several years, and they wanted to create a sustainable business before they went out to the public market.
That's true,
and that's not typical. Most of the companies going public this year are not profitable, and their profitability is in some cases probably in the distant future. And
that's right.
Yeah, I think they've done a great job.
So I guess we should keep an eye on Estonia.
Estonia is a hot, yeah. I mean,
exactly.
Estonia's got some good companies. We have. I mean, I think it's it certainly punches above its weight for its whatever it is, 3 or 4 million population they have.
Totally.
Yeah. Okay, so let's move on. Close to home now. Blend. They've launched a roadshow. They're going to do an IPO. I'm not sure exactly on the timing. It's going to be sometime over the summer. They're going to raise up to $360 million with a $4 billion valuation. This is another company that has just executed really, really well. They started off just in the real estate space, trying to digitize the mortgage process for banks, and they've really they've branched out into other areas of lending, and they've really branched out beyond just the loan application process into the whole closing. And I think it's again, this is another company that has done the mortgage process. The mortgage process is still very inefficient, but it's getting better, and Blend is part of the reason that it is getting better.
Perfect. They almost came along at the perfect time where they were set up to take advantage of what happened the last 18 months. It was like, they launched in, I think, like 2017, 2018. They made that acquisition to get closer to a full end-to-end solution. And, they've really taken off the last year. And it's been a pretty interesting company to follow. And if one space needs it, I would say the real estate needs to become significantly more efficient, and it's getting there. But still, I mean, I did a refi during the pandemic, and it was still pretty excruciating.
Yeah. I'm actually selling an apartment right now. Let's not go there. It's painful. But the interesting thing about Blend is that it's part of the sort of broader story of the incumbents digitizing. This is the banks versus the fintech story, right? The banks need Blend, and I think they always needed players like Blend. But as you were saying, Todd, I think the pandemic just made it very real for them, right? And they couldn't use their physical infrastructure. They needed to rely on digital channels, and the ones they had were just crappy. And so I think this is part of that. And I remember a story of Italian banks, in the middle of everything that was going wrong in Italy last year, overnight, just over a weekend, approving billions of dollars worth of digital transformation, like just stuff that was sitting, sort of at the board level for years. Suddenly we're like, we got to do this because we can't survive. Yeah. And so Blend is perfectly situated for that. The question really is, can they do this in other spaces, right? I think that's part of the IPO docs, right? They are promising that they could be the platform for all sorts of account opening in all sorts of verticals beyond real estate. I'm just not sure that that's possible. Real estate is so damaged that it's so sort of archaic rather, and so much analog that there's a huge opportunity. But I don't know about traditional account opening and in other sectors where there's such a need. Yeah,
there's a lot of solutions in that. Play in those spaces right now.
Exactly.
And maybe auto is one that they could attack. But if you're going to try and attack like HELOCs or personal loans, I mean that's already pretty streamlined. For after 10 plus years of fintech activity.
I can get an unsecured consumer loan before we start our next story.
Yes,
exactly. It's part of the problem.
yeah, that
too. Anyway, let's start our next story, and I want to talk. This is now, I think, the 4th or 5th week in a row we are talking about overdraft fees, and I'm going to keep talking about it as long as people keep writing about it, because it is I think it's one of my favorite topics. I think banks should the whole overdraft product should be abolished, and I think it will. It's taking its time, but anyway. So American Banker had a piece out just yesterday talking about. They basically just went through all the 10 major banks that are all making movements in the overdraft space. And we've gone through some of these before, like Ally, PNC, TD Bank, Regions, etc. But they just did a nice piece basically going through every single one. And I think, we're going to I'm going to be keeping tabs on it. I think it's great. Hopefully next week we can talk about overdrafts again, because some other major bank is making moves in this space, because I think it's a horrible product, and one that I'm sure from you guys at Flourish, Kabir, that you probably don't like seeing overdraft fees coming being dominated at banks as well.
Absolutely. I mean, frankly, I was going to tell you, like, keep it on as a standard item on your show. I mean, we should launch a website that says overdraft.org or whatever, and like we track every time this happens. We were talking about Robinhood making it possible, sort of being a disruptive force and making investing more accessible. Chime, Varo, right? Those guys are part of the story why overdrafts are going away, because they've made those sort of zero fee accounts available. We work very closely with Aaron Klein, by the way, at Brookings, who's done amazing work in this space, and he has a piece where I think he profiles all the banks that have 60% to 200% of their revenue
of their profits
comes from, and I think for JP Morgan and Bank of America is 7 to 8% of their profits. And so I think we definitely want these things to go away, and there's good reason for them to go away. I think it's kind of strange the way it's happening. I'm trying to understand the logic of banks that are saying, oh yeah, we're investigating this, and we're gonna sort of offer a low cost account. It's like, that was so 2015 or 20. It's like they're taking a step forward, but they're using a tool that is like 3-4 years old instead of just eliminating the fees completely. And of course, it's sort of what's happening in those boardrooms, given how critical these revenues are. Exactly.
They got to be able to replace them.
I think to bring up Ron Shevlin again, I think that piece he had a couple of weeks ago about JP Morgan.
Yep.
Once a bank like that, the biggest bank in the U.S., 60 plus million accounts, and they say no more overdrafts, the impact that will have on banks below them. And obviously they haven't done it yet. And like you said, some of the offerings from some of these banks are kind of going back in time, and they're just fee accounts that don't let you do an overdraft versus coming up with an innovative way. I think the PNC way, I think, was more at least in the line of innovative, which is we're going to give you 24 hours to rectify this, versus the TD version, which is, all right, here's a account you have to pay for. We'll just decline you every time that you get to the terminal if you don't have enough money in your account.
Yep.
So there's strange ways that some of the banks are going about it.
By the way, like with the Chime story, the underlying piece is government payments. I think the underlying piece here are the cores.
Right.
The cores set the floor on the cost for these banks, and the banks that rely on this more are the ones with the more dated core systems, and just are struggling to evolve from that. And so,
I think I read somewhere it's like $250 in cost per customer per year.
That's just ridiculous. And so I think that's part of the problem. And that's why even if you look at the Blend story, right, you need partners like that to evolve from this dated system.
Yep.
And I think banks will struggle.
Related to your thing, I think if you look at it, banks start in a negative balance with a customer, and then they have to make that negative balance up, which is ironic because they make money on negative balances. But essentially, the cost of a customer begins in the red, and then they have to move it to the black, and fees are part of the reason that they get there.
Exactly.
Yep. Well, I just before we move on, just a quick plug. I actually interviewed Aaron Klein last week for my podcast. It will be out a week from tomorrow, so look for that. Just a great interview.
He's awesome.
Love chatting with him. Okay, let's move on to Wells Fargo, because this is a story that just came out, broken by Hugh Sun at CNBC earlier this morning, just really about a few hours ago, talking about Wells Fargo has told its customers that it is closing all That's 100% of all the personal lines of credit that they have. And this is a product that is, they don't say exactly how widespread it is, but it's been a product that Wells Fargo has had for many years. A lot of customers have relied on it to pay off credit card debt, pay for home renovations, or anything that like a personal loan type product is paid for. And some of them are using them to avoid overdraft fees. And now they're basically, with very little warning, they are saying we are closing it all down. And it is, it's just, it's non-negotiable. There's nothing you can do about it. And people just have to go and find another avenue for personal credit.
Yeah, so one way to look at this is to say, this is sort of coming out of the pandemic. The bank is struggling and has to take various steps. I think they did something with their student loan business at the end of last year, something with auto loans earlier this year, right? There's been sort of series of things. But I actually feel this is potentially a positive story on the impact of pro-consumer regulation and pro-consumer regulatory intervention, right? I think this is effectively, a long-term fallout of what happened in 2016 when it was discovered that they were opening accounts, right? Falsely opening accounts. And that kind of sort of opened up a whole series of investigations into various bad practices. At the same time, I think the CEO still was ending up 2020 with $23 million, in income. And so I think the biggest story about the big banks continuing to hurt customers and the sort of the leadership of these banks going sort of unscathed somehow continues. I think it'll be interesting to see where that accountability lands.
Mm-hmm. And to pick up on that, even through this process, they messed up the communication because they didn't give everyone, I think it said in the piece, there was a 60-day notice. But for some of these, like all of a sudden, they're going to have to start paying minimum balances on minimum payments on these balances. And I think, Peter, you were saying it before we went live, like, they could have given them a 6-month notice. Like, just shows you how non-consumer friendly banks are. And
that's
it's like,
right.
Just they make a decision, they do it, and it's in the best interest of the bottom line of the bank versus, how could this impact our customer base, one way or another?
Well, we were saying good or bad fintechs. Good versus bad. I think the good versus bad banks, right? You have the Ally PNCs who are trying to figure things out versus these guys. I mean, 60 days is 2 paychecks, or for some people it could be that will hurt people's credit scores for sure, and that's a long-term structural issue.
Yeah, it will, and keep in mind too, as you said, talk on the regulatory side. I mean, from my understanding is that Wells Fargo were told that they were basically said they cannot increase their balance sheet because of they basically had to freeze the size of their balance sheet. And maybe this is a product that their balance sheet is growing. I mean, there's so much demand for lending right now with all the home mortgages, and Wells Fargo are huge in home mortgages, but they've got to probably trim somewhere, and they thought, here's a place we can trim. But just before we move on, 60-day notice, and then the remaining balances will require regular minimum payments at a fixed rate, and it's going to be it's going to basically convert into a term loan. Don't know exactly what those terms are going to be, but it's it certainly says it's going to hurt credit scores, because this is sort of, someone might have been using $5,000 out of a $50,000 line, and that's 10% utilization, and suddenly they're going, that's going to go away, and their utilization is probably going to go up. Anyway, we're almost out of time, but I do want to get just one quick last story in. I want to talk about Circle. This is a crypto company that is going to go. They've announced, I think it was just today, they're going to go public via SPAC. They're going to raise $691 million, $4.5 billion valuation. Circle provides, they operate the stable coin. That's how I know them, USDC, the US dollar coin. And it's a stable coin. It's got like $25 billion in market cap, and it circulates widely. And they also provide infrastructure for software infrastructure for other crypto companies. And they're going public. Another sort of big win for the crypto space, it seems.
This is one of the crypto companies that haven't followed the flashy, marketing way of many in the space. It seems like Circle had a little bit of that early on, but have since kept under the radar for the most part. And now, they're seeing that pay off with the SPAC and I think a $400 million pipe deal as well. And so I think, payments infrastructure, stable coin, that's the I'd say medium term future of the space. Long term, I think there's a lot more going on, but I think they're well positioned for that shift.
Mm-hmm. Yeah, I think what's interesting is I think the $25 billion worth of USDC in circulation. I think it was a 6,000%, I believe, increase last year in circulation. Right. So that's behind this, right? And part of what's happening here is the integration of the crypto world with the traditional finance world. I think Circle is sitting in the middle of that. I think they also introduce a savings product. They've introduced a deposit product with another partner, if I'm not mistaken, recently. And so all of that is sort of bringing this infrastructure together. The question I have is that this is positive for the stablecoin part of the crypto world, which is the part that will integrate with the traditional finance system. Yep. But it's also the part that will integrate with CBDC, central bank digital currencies, which is the big shift that we are all living through. I think it's going to be interesting how all of that plays out. I think it's very exciting news, frankly, for the industry. It is.
Yeah, that will be exciting. And that's a topic for another day, but we are out of time. Kabir, thank you very much. Todd, thanks as always. And thank you all for watching. We'll be back same time next week. Have a great weekend, everybody.
Thanks, guys. Yep. Thanks, guys. Take it easy.